So again, this is trying to work with Toan, and it's kind of a little bit work in progress. But so I'll be really interested in the feedback that you guys can give me here. Again, sorry for the technical glitches. Um, you know, the motivation, I think it's something everyone here knows, which is that, as climate changes, there's an increased risk of, natural disasters, and in particular storms and floods and, hurricanes and cyclones. And this is already ongoing, right? So this is not something that, it's like 100 years in the future necessarily. I mean, could be worse in 100 years in the future, but it's already ongoing. And one might also think about these cyclones as being a particularly large problem for, small disaster-prone areas like, perhaps like small islands. But the thing is, I think recent evidence by, Chang and Gina has shown that, these kind of cyclones can have very persistent effects at the country level, right? So, they estimate they do this very careful work of estimating the impact of a cyclone in a country. And they find that, 20 years after a cyclone hits a country, their output is below trend, right? And large cyclones, they can, have as big an impact as kind of a banking crisis. Also, there's a relationship between the damage of cyclones and financial development. So, Lint, who's here with us today, is going to present soon. In a paper with Laura Backinson, has verified that this was the case. Countries that have like more financially developed countries tend to do better in response to cyclones, and the less developed, financially developed. And then von Peter et al. Have kind of tied this to insurance coverage more narrowly. There's some evidence for financial effects. Some people have found that, after these kind of cyclones, countries tend to default on debt, for sovereign debt, and may have harder time borrowing. And also people have found that before cyclones, so ex ante, countries that are more exposed to these kind of disasters may face higher bond yields. So this is about kind of putting, some of these things together and trying to think through, financial adaptation. So the notion that, part of the damage from, being exposed to disasters comes from the fact that financial markets are imperfect and that countries need to borrow abroad, and that's kind of, not something that takes place frictionlessly. And there has been calls to kind of, try to think about credit instruments and debt instruments and financial instruments that are more narrowly tailored to a world in which these kind of natural disasters are a bigger deal. So one case in point is Grenada, who has adopted these kind of catastrophe bonds, which are bonds that have a clause that say, if you have a large hurricane, you don't need to pay. So we're going to be looking a little bit into these kind of things. So specifically, the way we're doing this is we're going to look, through the lens of a model that, it's going to be a model that we can quantify, and that we're going to try to make it as tractable as we can. And it is a model with capital. So, the effect of disasters is that it destroys capital. And it is a model that has strategic sovereign default, which is the key friction, that the international finance literature has identified as impairing capital flows between more developed and less developed countries. So the idea here is, we're going to have these countries. They're going to be subject to this kind of climate default risk. So when a disaster, hits, they lose capital, and they may be tempted to default for that reason. And we're going to examine how that takes place in these kind of models. And then we're going to think about, this financial adaptation, which is, different from the kind of physical adaptation ideas that, say, Esteban discussed, where people are kind of settling in different places. So this is more about, if you kind of bring new instruments to the table that are, kind of have more state contingency, of course, these are going to be good things, but how good and in which ways, and there are kind of some interesting details about how that takes place, and we're going to look into that. And then, we're going to have this model quantified. And the main mechanism here in the model is that we're going to find is that, there's going to be this feedback here between capital and the default risk and the ability to borrow, right? So when a disaster hits, the country loses, net worth. It loses its wealth, part of its wealth, because some of its capital gets destroyed and some of its output, becomes lower. It's not able to produce as much. And because of that, it has a harder time investing because it can't just go out and borrow that easily. I mean, in order for the country to borrow, it needs kind of some skin in the game, right? And the way it can have skin in the game is by investing, is by having capital. But it cannot invest because it doesn't have the resources. So this gives this kind of vicious cycle that basically holds back the recovery. So if you think about a small open economy that loses part of its capital, in a world where capital flows are free to move across borders, you would expect to see capital snapping back to some kind of level that is compatible with world interest rates and world marginal products of capital fairly quickly, right? So in our model, we're thinking about like 5-year periods. So in the year when in the period when you lose the capital stock, there's nothing you can do. Think about adjustment costs, but then the next period you should be back. But that's not what happens. I mean, what happens is that you have this very protracted recovery, which is kind of a little bit more in line with the Shang and Gina findings that these hurricanes have very persistent effects. Now, we still have a recovery. I think if you look at their estimates, you don't even see much of a recovery. So perhaps they're not explaining the whole thing, but we think we're capturing like a substantial part of what they're talking about. And then, we can do some welfare analysis here. There are several problems with welfare analysis in the setup. I mean, one is the kind of stuff about population that Toan brought about. I mean, it's not an issue for us so much because we don't have endogenous population. There's another issue, which is how you think about the welfare from the perspective of people who are sitting here today and are facing all of these changes, and people who might be sitting in the future and how their welfare looks. I mean, this was the object of some debate in the literature. We kind of look at both of these things. So if there's like a 20% increase in cyclone activity starting right away, right? So that's kind of more dramatic than what really happens. You'd have like a 1.6% reduction in welfare as measured in consumption equivalent. So people would be willing to give up 1.6% of their consumption forever in order to avoid that. And then over the long run, if you think about people sitting 100 years from now, there'll be 3.2%, less, it's equivalent of them having 3.2% less consumption. And this is because, as disasters become more frequently, you're kind of losing more of your wealth along the way. And then, these people are going to be poorer. Financial adaptation, the kinds that we investigate, they can reduce this welfare loss, but is a relatively modest size. So it's about 17 percentage points. So instead of, or 24 percentage points over the longer run. So instead of, 1.6% permanent consumption loss, it's a 1.4. And we're going to talk about that. There's a literature that I'm going to skip. I think the main thing here is, I think we're the first ones that have write a model that has capital, sovereign default, and climate disasters going on. Okay, so the model, I mean, we try to keep it simple. As I mentioned, the periods are going to be 5 years. So a lot of the things that people build into macro models to generate, persistence, for us are kind of less important, right? So in particular, we're going to think about, no adjustment costs to capital and things like that. And how does it work? Well, you produce some output and you produce that using capital. And there's some TFP, labor supplied inelastically. And with some probability, a disaster strikes and, there's a distribution of disaster sizes and that generates some damage to your capital stock. And everything is IID, including the growth in productivity. It's IID. There's going to be some representative household in each one of these countries that is going to have Epstein's preferences. So this is so that we can price the risk or evaluate this, make these welfare evaluations in a way which is consistent with how the finance literature thinks how people price risk. And all of these variables, you can detrend them by TFP, which is going to be growing stochastically over time. Each period, the sovereign in the country, so think about some sovereign making decisions on behalf of the country, is going to pick some amount of foreign borrowing, BN, and it's going to pick some level of capital. And then next period, so these are all normalized by TFP. So next period, the normalized wealth and, normalized debt and the normalized capital stock are going to depend on, the growth realization. So, the growth increases the base that you're normalizing it by. But also, of course, the capital stock is going to depend on whether you're hit by disaster and how big the disaster is. And the sovereign is going to make a decision about default. So the way we model default is if you default, you lose a fraction L of output. The sovereign default literature sometimes has like more complicated punishments that depend on exclusion. The finding is that these actually don't have a lot of quantitative bites, and then in the end they add like a default cost of output. So we're kind of just cutting the middleman, going straight to this. It's going to afford us a lot of tractability. And basically here it is. So this is your net worth if you repay, right? So you produce some stuff, you have some capital depreciated from last period, and you pay your debt, right? But then if you don't repay, you don't have to repay your debt, so that's zero, but you lose part of your output, right? So that's kind of the trade-off. And then you basically default if your debt is high relative, to your output. So the model is very tractable. There's a single state variable. Things are pretty much IID. So that makes it kind of easy to compute. And then one thing which is kind of important also in that literature is we have a closed form for the spreads, right? So lenders they understand that default is a possibility. And then, they're going to charge interest rates accordingly. They're going to charge a spread over the usual interest rate. So that's reflected in the price of the bond, right? And the spread is a function of just the probability that your debt to GDP is bigger than some threshold after you account for, growth rate shocks and the disaster. So this is just a model, right? We can look into some analytical results. It affords that. So one of the things we can look into is just a spread schedule. So, spreads are going to be a function of your capital stock and of how much you invest, how much capital you plan to have, and how much you borrow, right? And again, the default threshold depends on your debt to GDP ratio. So, it's pretty straightforward. If your debt is high, that means you're more likely to default. But if your capital is higher, that means your output is going to be higher, so you're less likely to default. So this is the sense of this kind of skin in the game aspect to this, right? So if you invest more, you have more skin in the game. You have more to lose by defaulting. And actually, there's this kind of nice closed forms that depend on the hazard function for this distribution here of your, the growth rate and this disaster kind of piece. This is the kind of the mechanism that I mentioned, right? So if you lose net worth, you have to reduce how much you invest, how much capital stock you have. That increases your default risk for any level of capital stock and debt. So for that reason, you decide to invest even less because you cannot borrow as much. So that kind of gives a slow post-disaster recovery. Another result that we can derive is that, as the probability of disaster goes up, or, as disasters become larger, the distribution of disasters, say first order stochastically dominates what came before, spreads are going to be higher for any level of investment in that. And the reason is you're increasing the probability of like low tail events as far as your debt to GDP ratio. Okay, so let me talk about the quantitative exercise that we do here. The model is very parsimonious in terms of its calibration. So that allows us to calibrate it, mostly from off-the-shelf parameters. So the discount factor is 0.96 per year. As I mentioned, the period is 5 years. So the discount factor is 0.96 per year. So that's kind of in line with like most macro models. And it's actually, not as high as what you would find in typical sovereign default models. I mean, those models typically, people assume countries are much more impatient Depreciation is 10% per year, also standard. And we're going to have like world interest rate at 1%, kind of in line with recent trends. So that does, the country is impatient relative to international, interest rates, and that will give like a motivation for the country to want to borrow. The preference parameters, we take them from Guriel. He has a paper about disasters in a closed economy with capital. And these are numbers, which are kind of compatible with the finance literature. And then Agar and Gopinath, they study TFP growth in emerging economies. And, they make the argument that in these countries, like TFP trends are really important. And we, again, use their numbers. Of course, it's quarterly models, so we have to bring those to the kind of 5-year period. The cost of default, we take it to be 10% of 5-year output. So that kind of means that countries can sustain something like a 50% debt to GDP ratio. I think the parameter here, which is kind of a little bit less, standard in the macro literature, though perhaps not so far off from the growth literature, is the capital share. So we think of capital here as encompassing both physical and human capital. Disasters kill people as well as destroying structures. And that's kind of the Menke Romer Weil kind of number. So, this is going to afford us a bunch of persistence in terms of like that recovery path. You can kind of see like if that was closer to 1, we would have perhaps almost no convergence. And then we spend like, a bunch of effort calibrating disaster risk. So, we're going to focus on cyclones. I think I mentioned that, it's relatively well studied, both climate sciences and economics. So we can draw on a lot of prior work here, including by Lind. And the way we think about it is there's a chance that hurricanes make landfall. They may have some size in terms of like, maximum wind speed in meters per second, and then they have a marginal economic damage. And we're going to take these numbers from like the Shang and Gina study, right? So they have a table where they give descriptive statistics of how frequent cyclones are and of different sizes. So how big is a 10% cyclone? How frequent is a 10% cyclone and how big it is? And how frequent is a 1%, sorry, I think 90% and 99% cyclones, and how large those are. So we can use those to kind of calibrate things. We fit like a Weibull distribution to that to those moments that they report. Of course, you also estimate the marginal economic damage for different horizons. So we get the marginal economic damage for like the 5-year horizon. And then we let the rest of the economy converge as it does. And we fit a Weibull distribution, that follows also, Laura Backinson and Barrage. It has kind of a thinner tail than say a Pareto distribution. And then we can look at impulse response functions, right? So how do we construct these impulse response functions? Simulate 1 million countries for until you get some kind of ergodic steady state. So for a number of years or a number of periods. And then at time 0, what we're going to do is we're going to say whatever disaster size those countries would have, right? We assume that at time 0 they're going to have a disaster size which is a meter per second larger, right? So that's kind of like all of the countries in the simulation have like a slightly larger disaster size. So that is the size of the cyclone here relative to the kind of ergodic steady state. And then you see like output dropping, right? And as I mentioned before, as I foreshadowed, you get this very long recovery with a half-life of about 20 years. That to GDP spikes up because the bottom is falling out. GDP just drops. And then spreads spike up and defaults go up, right? So a lot of these countries default. And then they start to try to borrow. They want to borrow abroad, right? Because their capital stock is low and their marginal product of capital is low. So this will make them wish to borrow enough that their spreads go up. But the fact of the matter is it's hard for them to borrow, so much so that because they lost their capital stock, so much so that capital flows go down, right? So you have this kind of perverse effect. In the emerging market business cycle literature, people refer to that as kind of when it rains, it pours, right? So even though you're having you're in this disaster state, and you really need capital from abroad because your capital is, your marginal product of capital is high, actually capital, you have less capital flowing in. We can look at a Maria-sized shock, you know, and then you can see some nonlinearities here with default. You know, it's just at that point, you know, the probability of default is much larger. So that's the setup, right? And then we can look at climate change. So how are we going to think about climate change here? Again, we're focusing only on cyclone risk, right? So temperature increases, how they affect productivities. I mean, all of that stuff, we're not looking to them. And of course, there's like a huge, you know, range of things. I mean, this is really focused on the cyclone risk part of that. And then Emmanuel, you know, he describes different scenarios for you know, increase in cyclone intensity. And we look at the business as usual scenario, and you know, it's very heterogeneous again, right? So in the West Pacific Basin, hurricane intensity is projected to increase by 20% in that scenario. In Oceania, it actually goes down. So we're going to think about a country in the West Pacific Basin, and that includes a lot of, like, you know, large emerging markets like, you know, Southeast Asian countries and parts of China. And we're going to see what happens here. Again, there's no physical adaptation, so that's a sense in which, you know, the effects here are overstated. People are not building away from the coasts or anything like that. On the other hand, you know, we're just focusing on the cyclone risk. And the way we do this is a change in the scale parameter of this Weibull distribution of disaster sizes. So, you know, one way to think about this is if this is the CDF of disaster sizes, for any given, you know, percentile here of disaster size, after climate change, the disasters are going to be 20% larger, right? So this is the kind of shift we're looking into. So the whole distribution shifts to the right. And you know, then we can look at the welfare cost of increased cyclone risk. So here, think about the country, you know, with a certain level of net worth, right? And then you learn that cyclone risk goes up by 20%. And you know, so your consumption is going to change by about, you know, 1.5%. Or you would be willing to give up 1.5% of your consumption forever in order to avoid that scenario. You know, we can also calculate what is the overall damage from cyclones. I mean, you know, that's not really like something which is policy relevant directly, but it gives us some kind of ballpark in terms of like how big a deal these things are. And these are pretty large. We're talking about like something like, you know, 8.6% before climate change. So you compare that to the welfare cost of business cycle fluctuations. Of course, it's much larger. Business cycle fluctuation, you know, this is not just a business cycle fluctuations, you're actually destroying capital. And it is kind of in the ballpark of the cost of many disasters that, say, Jordan et al. Have calculated, but including all sorts of disasters, not just cyclones. Okay, so now I'm going to talk a little bit about financial adaptation. So we're going to think about two types of instrument here. Right. So one is insurance, right? So you could imagine that individuals in these countries would be insuring against, you know, losses in their capital, and that a bunch of that insurance may have, you know, international links, right? So you insure with a local company that has, you know, a reinsurance agreement with Swiss Re. But as it turns out, I mean, insurance coverage in these countries is pretty low. So Bakens and Barrage, they have data from Munich Re, and they kind of report those numbers. It's less than 10% of damages are covered by insurance in those countries. So we're going to try to think about, okay, you know, how much they could gain, and in which ways by having, you know, better access by having full insurance coverage. Another one is catastrophe bonds. So, you know, I mentioned Grenada in the beginning. They issued those bonds that have this catastrophe clause that says, you know, you don't need to pay out if you have a disaster. And I think the idea here is that this avoids kind of the messiness that comes from default when you're trying to renegotiate your contracts from scratch with like all your creditors. So you avoid the default costs essentially, right? these are not very used. I mean, it's like you look at sovereigns don't typically issue that. So Grenada is kind of the exception that proves the rule. They're like a really, small island that is, has been ravished by hurricanes in the past. But one can imagine, I mean, it's a growing market, right? I mean, in the private sector. So one could imagine countries being able to use this in the future. And the question is, how much could they gain by using that? So we start with disaster insurance. The assumption here is that countries can buy disaster insurance in the following way. First, they buy it within period. It's intratemporal, right? So again, the period is 5 years. So we're not thinking about you have to commit to insurance 5 years in ago, 5 years in the past. I mean, you can kind of buy it, on a kind of a running basis, and disasters are kind of a discrete event that happens suddenly, and you can be insured about that against that, even if you kind of buy the insurance a little bit of time in advance. And they're sort of actuarially fair prices. So, that's again kind of thinking about this kind of best case scenario. And the other assumption here is that the country receives the insurance payment regardless of their default decision. So again, you could think about the countries as kind of timing these things a little bit. I mean, you first get insurance, then you default. At that point, foreign lenders cannot kind of try to kind of claw back, your insurance payouts. It's not part of your assets that are abroad or something. And the timing is going to be such that, beginning of the period, the country observes what its G realization is. So you kind of know when the period starts, what your growth prospects for those 5 years are, from like, the standpoint of your productivity. Then, you make an insurance decision, right? And then a disaster strikes. And then after the disaster strikes, you make a decision of whether to default or not. So that's kind of how this goes. And, so the upshot of that is the value function is going to be concave for these countries, right? I mean, in terms of wealth. So if they have very little wealth, it's kind of great because they can, or a little bit more wealth is very important for them because, it allows them to invest in high marginal product of capital projects. If they have a lot of wealth, it's kind of easy to invest, and additional wealth doesn't give them as much. So it's concave, and what they're going to try to do, they're going to try to smooth wealth, right? So they're going to pick insurance, they're going to buy insurance to make sure that whatever wealth they end up with, after they know G, right? Whatever wealth they end up with is kind of the same on average, irrespective of whether a disaster strikes and how big the disaster is, right? So this is going to be, kind of how this changes their problem, right? And then I think one of the important things here is that the choice of insurance does not affect their incentives to default. So their incentives to default depends on how much debt they contracted last period, how much capital they invested last period, and the realization of these exogenous variables, which are the growth rate and the disaster. So it's really about output, debt to output. The fact that their net worth gets insured doesn't really affect their incentives to default. So that's insurance. We also have act of God bonds or catastrophe bonds. What those bonds do, the way we think about this is, now you're making a decision of whether you want to borrow or not in any given period, right? This is kind of 5-year debt because you're borrowing from one period to the next. But then part of their debt, you can kind of decide to have the kind of disaster clause. And the disaster clause says, if a disaster is bigger than some threshold, D bar, you don't need to pay that part of the debt. And there's no default cost associated with that. Now, the thing is, when you default, it's not selective default. So when you default, you're paying the fixed cost no matter what. And then, you're going to look at your overall debt levels. So one of the things that this does is that it changes your default incentives, right? So if I go here to what is your debt level, next period, it's going to depend on what fraction of your debt portfolio is the cat bond and whether you have the disaster or not. And when you make the decision whether you want to default or not, right, you're going to be comparing this kind of reduced debt level with your output and your capital stock, right? So this keeps your incentives to this kind of keeps your incentives to default more under control, right? And of course, that's going to affect your price of, your cost of borrowing, right? So one of the things we find is that, and we can show this analytically even, is that you get this kind of cat bond Laffer curve, which is if you have if you don't have any cat bonds at all, and then you decide that you want to have a little bit of cat bonds, so you set theta to kind of a small number. This is good for you because it provides you with some insurance, right? But it's also going to make the lender feel safer that you're going to repay, because they know that if a disaster strikes, your debt is not going to be as high, and then you're not going to default on the whole thing. So they're still going to charge you, right, for that insurance premium. They're still going to charge you for whatever amount of the debt you're writing off, but they're not going to charge you for the whole thing that you're going to lose if you default. So that's an advantage, and that's kind of a reason. So I think this is the algebra. I don't think I have much time to talk about that, but the key is, there's this kind of double advantage, right? And then at some point, you kind of exhaust the gains from this reduction of default probabilities, and then basically it becomes more of like a traditional insurance kind of trade-off about, do you want to pay the premium? The other thing is, there are a couple of limitations to the benefits from this cat bond. One is countries are impatient, and they're making this decision 5 periods in advance, so they may not they may not want to do so much of that for that reason. The other one is it only insures you in states of the world where you don't default. In the states of the world where you default inframarginally, right, where you're going to default no matter how much, whether you have a little bit more of the cat bonds or not, you're going to default anyway, so you don't really have any benefits from having these cat bonds. So this kind of limits, the benefits of that, and this is something that Olivier Jean has a paper in the Journal of Developer Economics where he talks about that. But the key here is that the benefits are complementary, right? So on the one hand, because you have insurance, you can smooth the path of your net worth. So it doesn't take you as long to kind of, make this kind of long, protracted recovery. On the other hand, the cat bonds help you avoid default. So the cat bonds are going to make your borrowing cheaper ex ante, whereas the insurance is going to help you with the exposed disaster recovery. We can put numbers to these, and the numbers are relatively modest, as I said, these are kind of the short run numbers. So again, thinking about someone sitting today with a certain amount of wealth, and these are the long run numbers. So thinking about, some kind of average person, sitting, in the far future after, the economy had time to do an, transition to a new ergodic steady state. And it can be a little bit puzzling. So the cat bond numbers, they're actually in line with Jean's findings, and I think I kind of explained a little bit. They have to do with, you don't get complete insurance and you're kind of impatient. The insurance numbers are kind of a little bit more puzzling because, I started out by saying you had this huge, drop in output, and it's very protracted recovery. So why is it that, you can't get much gains by kind of making that recovery quicker? The reason is, in this kind of world, in this kind of environment, how much you can invest, how much capital you can have is a function of how much wealth you can have, right? And what insurance does is it doesn't make you wealthier, it redistributes your wealth over time and over states of the world, right? So essentially what it does is it takes some wealth from times when hurricanes are not a big deal, and it redistributes it to the times when it is a big deal. So you do get a quicker recovery, and that's a good thing because you don't spend so much time with marginal product of capital in these kind of really high places, right, when capital is really, really small. But on average, your wealth is still kind of capped low by the fact that hurricanes exist, right? And incidentally, these are kind of the whole gains from moving from no insurance to insurance, right? So that's not interacted with the climate change. So this is if you just go from nothing to something. So to conclude, I think I might be even a little bit early here. We looked into the kind of climate default risk and this interaction between physical risk of climate-related disasters and the financial risk of sovereign default. we look into financial adaptation, and we find that default risk is going to delay the post-disaster recovery. That there is a significant potential welfare loss from climate change, just from like the cyclone aspect, not taking into account some kind of physical adaptation, and that the financial adaptation can help to a degree, but it's still something that is modest as far as the kinds of instruments that we have looked into. So as I mentioned, this is work in progress. I think there are a few more things we are planning to do, and of course we're going to be all ears if people here have other suggestions. One of them is to think about other forms of financial adaptation. So for example, one idea is think about foreign direct investment. I mean, here there's this notion that you're investing and you can default on how much you borrow. You can imagine like foreigners who have jurisdiction abroad, and if they borrow abroad, they cannot default as easily. And those foreigners are making the investment decisions at home, and they own the capital at home. Of course, you could still, it's still kind of an interesting and complicated object to think about. There are trade-offs that are associated with that, and I think it's worth thinking. The other one is, look at data. So we obtained the Swiss rate data. So there's Munich rate, the Swiss rate. We obtained the Swiss rate data on insurance coverage by country. So we can use that to test some of the model implications, revisit some of the, Pakistan and Barrage and Shang and Gina kind of results, but kind of more narrowly tailored to what we were doing. But also we can try to think about the empirics of financial adaptation. So, how is it the case that countries that have become more exposed to natural disasters, is it the case that those countries are increasing their insurance coverage, and to what extent? And then one thing we thought about is also incorporating asset prices, perhaps with like some capital adjustment costs, because this can allow us to kind of bring forward, longer run effects of climate change. So one could imagine, if you have like some news that climate is going to change in the far future, that could affect the price of capital in the current period. So that allows us to think about the transition in a more structured way, in a more interesting way. So this is what I've got. Thanks for your patience with the technical glitches, and happy to take any questions.
Nice. Thanks so much, Felipe, for this very interesting presentation. I'm going to invite Emile Marin to kick off the Q&A session.
Hi, Felipe. The first is on the output losses of default. Because the disaster leads to a direct loss in output, this means that the cost of default in a strategic environment is immediately lower. It feels a little counterintuitive because exactly when the disaster happens, that's when we see these countries borrowing a lot. So something like financial autarky feels like it would have a lot of bites during these times. More so if we think that there's a lot of foreign aid coming into these countries at this time, it feels counterintuitive that the country would default on creditors that are also potentially sending aid. Did you get that? Okay.
Yes, I got it.
And very briefly, the second question is about the benchmark comparison. So you're looking at these ex-ante measures, which are very interesting, the insurance and the catastrophe bonds. But in practice, we already see things like aid flows and also collective action clauses, so debt standstills, which are both ex-post measures. So I wonder how much quantitatively the ex-ante measures really help on top of these ex-post measures that are already in place.
Okay. No, excellent. I mean, I think these are great questions. I'm happy to talk about these things. I don't think we have great answers to do that. I mean, the foreign aid piece is certainly something to think about, especially that interesting link you mentioned between the foreign aid and the creditor countries. I think there is evidence that countries do default more often after disasters, but so I don't know how much bite that has, but it is something worth thinking about. It is true that our mechanism is like it's pretty direct. I don't think we're thinking that we're making some deep contribution here in terms of like sovereign default and what kind of keeps country from sovereign defaults. But again, I think it does capture that notion that sovereign defaults become more probable after the disaster strike. The evidence on capital flows that you mentioned, I mean, I think this is something we probably need to look a little bit more carefully into, because it is true that we do get this kind of reversal in capital flows together with the disaster. So, anything that you have to kind of share with us on that, I think is certainly something, that we should look. I kind of see the CACs, the collective action clauses, as kind of perhaps a more kind of all-purpose version of the cat bonds, and perhaps that explains why cat bonds are not as much used, because perhaps countries are already covered in that sense. Yeah, I kind of wonder how prevalent the CACs are, but I think that's certainly something, I think that's interesting to look into. Thanks.
Awesome. Are there other questions from the participants?
I ask one question, Zaina.
Yes, please.
So, Felipe, I mean, you want to take this quantitatively, right? So the question is, what's kind of, because you have all the evidence also on disaster and default. So how is, kind of, if you look at the micro empirical evidence on disasters and default, what's really kind of, is the model really fitting in some way what you observe historically?
Yeah.
Or shall you look at the data also on these, in order to fit down the model?
So I think our model suffers, and I think this is something I might have wanted to add to our to-do list. Our model suffers from a problem which I think it's kind of plagues a lot of the sovereign debt literature, which is spreads are kind of low, right? So countries are kind of very, very, they behave strategically in the sense that they really kind of bring their debt down in order to kind of make default less likely, right? And I think in terms of a lot of the questions we're asking, that might not be such a big deal, because I mean, it is too true that the possibility of default if you borrow a lot is something that is important, but it will make our framework, give our framework a hard time as far as matching these things in a quantitative stance. But if I got your question, Thiago, I mean, I think your point is like, perhaps we want to look at also this at the firm level. Is that what you meant? Like not just countries, but.
No, I was thinking at the country level, actually.
Okay. Yeah. So I think, we need to kind of do like a more detailed work of like matching what we have to different empirical facts. As I said, it's a parsimonious model. So I think we get like some ballparks from it, but I think there's certainly more work to be done there. I see there are a couple of questions in the chat.
Yeah, Lint has a question, Esteban has a question, and participant Kian has a question too.
Okay.
So
let me start with Lent because she put it here first. COVID. When Phan and I started, we thought, hey, we could actually talk about COVID. I mean, we kind of dropped it because I think there's just this it just has its own kind of path and evolution and characteristics, and we felt that we'd rather like focus more narrowly on like a particular kind of disaster. I do think it would be fascinating to think about. I unfortunately don't have much more to say about that, but it is something that did cross our minds, that's for sure. And then, right, adverse selection, yes, I think we could certainly make the model more rich in that dimension. But again, I think we were going for tractability and parsimony at this point. Esteban.
Yeah, so I was thinking about like the contingency of aid, right? And the extent to which the fact that this aid, every time these disasters happen, aid is forthcoming and, everyone kind of knows that this is going to happen. And so it's essentially, it becomes an insurance mechanism for these areas, right? I mean, so the government is going to come and is going to invest it. And the government really has no commitment not to do it. So let private markets in some sense and let the locals kind of insure themselves, because the government essentially cannot commit not to intervene once the disaster happens.
I see, right? Yeah.
And so isn't that exactly destroying these markets and like the private side of these markets? But on the other hand, maybe everyone is already insured because everyone understands that the government is going to come and provide aid when the disaster happens.
But are you talking about foreign aid, or are you talking about aid from the domestic government, or just everything in general in a sense?
Both. I mean, both. I mean, both are happening. Certainly, if you think about like local, events in the U.S., I mean, that is very pronounced. But not only that, I mean, there's the clear mechanisms where that you declare it an emergency, and then the aid is released. I mean, there's a whole process even by which it happens, right? So that you can count on it. It's not.
I think our presumption is that foreign aid is kind of relatively small compared to the size of these things, but I think this is something we can, pin down more carefully.
But I mean, and you think about IT, etc. I mean, there was a significant amount of aid coming, and so
Haiti, yes. Yeah, I guess. Yeah, the question is like how big it was relative to like how large the disaster was. I think Haiti still took a long time to rebuild.
No, relative to the part that you would like to insure.
Yes.
That's the relevant question, right?
Yes.
How big it is relative to what you would insure in private markets.
Right. So I think this is something we need to pin down. I think that's an excellent suggestion. And I do think there's the other question, the other thing that you put, which is like, what is the friction that is making these countries, these kind of insurance levels so low in these countries, right? And I think that's a fascinating question. We have thought about that. We have thoughts about that. I have a few more minutes here. I can talk perhaps a little bit, but this is certainly one, this kind of moral hazard. I think there are probably all sorts of government interventions that also kind of make it hard for like local insurance companies to kind of charge, the correct premium, because exposed people, people are just kind of, they don't want to pay those premium, and the government says, well, that's kind of gouging or something. I don't know exactly, the economics of that, but this does seem to exist. And I think, more generally think about this. I think this is certainly part of the agenda, I think.
Perfect. Felipe, we have one more question from Giancarlo
Yes.
Corsetti before the break. Giancarlo.
Hi, Felipe. Just on the same topic. So I was thinking like solidarity. You could think of solidarity as self-interested, a la Tirol. The part of the self-interest could also be, humanitarian.
Mm-hmm.
And you have the COVID case, for example, in Europe, where the idea of solidarity across countries has been strongly motivated by the idea there was no policy responsibility on COVID. It was a natural disaster. So there was no moral hazard. There was no policies, which is, debatable, but it was used. And the other thing which I would not discard, that even if not been helping the countries hit by a catastrophe, which means that may eliminate for some time the risk of a kind of belief-driven crisis or self-fulfilling crisis, that a certain level of that may be actually there. So there is an interesting question is whether part of the help can be stealth or off equilibrium, right? So it would be odd that the international community stands there looking without doing anything at the situation where, all asset manager and bondholder run from the country, exacerbating the disaster. Right. So that's an interesting question, that could also eliminate the state of the world, that we know is relevant for many of these countries in the emerging market, low-income country. Interesting things. Solidarity and off equilibrium liquidity, they may be contingent on a catastrophe. No?
Right.
Catastrophe.
So I'm going to paraphrase a little bit what I thought you asked, just because there was cutting off a bit. But if I understood it correctly, and the idea is, there's a humanitarian motive for like aid, but there's also a motive that has to do with like keeping the international financial system working in an orderly fashion.
There are two things. Yeah.
And yes, I guess just like our model is not set up to think about that, but I think it would be interesting to imagine how that could kind of work out.